So continuing with dividend policy here, we have our dividend distribution, right? And this is in shares. So you just distribute the fair value of the shares. That's what the equity comes down by, and that's what you credit the equity with. Okay? So on the date of distribution, that's what happens. Stock split. Okay? Stock split, all that really means that your shares numbers change. Okay? So 2-for-1 split means that, let's see here, you had 100 shares at 100 par and retaining earnings of 50, and now you're going to have 2,000 shares at 50 par. The value is still the same, retained earnings still the same, but notice you have more shares. You just have 2,000 shares now. So large stock dividend, when it's 20 to 25% of the number of shares previously outstanding, you have same effect on market price as a stock split. So when you have that large amount of shares issued, okay, what ends up happening is that you have more shares because you're issuing more shares. And the common stock dividend is the fair market value of the shares that you issued. So in this case, you had 1,000 shares. At the date of declaration, there was 1,000,000 shares. So we issued 30%. So we issued 300,000 shares at 10. So we have 3 million common stock dividend distributable, and we're crediting common stock by 3 million. Okay? And then there's a piece regarding presentation also. There's a piece regarding presentation where we're looking now at the entire equity chart of a company. And I want to go through this. You look at the capital stock. In here we have preferred stock. We have the par, the 7%. That's how much the coupon is, the dividend. Okay, and we have how many are authorized and then how many shares are outstanding. And then the actual value of these shares. Then we have common stock. Then we're also seeing how much that is, what's authorized, what's issued, the amount, actual amount. Now we have here also common stock dividend distributable. So we have an allocation for a dividend, okay? And this is all for par. Now here's the excess of par for preferred, excess of par for common. Then we have total paid-in capital here. Then we have the retained earnings. We have total retained earnings. And then total paid-in capital retained earnings. And then we have some treasury stock in here that's going to reduce these amounts. Okay? And then we have the total stockholders' equity. So this chart pretty much summarizes the whole chapter in terms of the presentation of the equities. And the important thing to keep in mind is that, again, looking at the simple version of this is that you have to understand that equity is assets minus liabilities. Always think back to that so you understand what equity is. Equity is just basically, if you just had cash and no liabilities, that's your equity. Otherwise, it's cash, your minor assets, minus your bond, so that's your equity. Now, this is more shows you what's the nature of the equity. It's kind of like, who do we owe the money back to? Who are my owners? Okay, it's just equity. It's just owners. Say I own my own company, so I've been putting money in. Okay, now it could be preferred equity. It's more like a bond that requires me paying annual payments of 8%. Okay, and then there's another aspect here of retained earnings. That's income I've been making over the years. I've been doing well, selling a lot of surfboards. So I got some income or accumulated income. That's what retained earnings is. Now, the distinction between par and paid-in capital is just sort of a legal distinction. numbers wise, that doesn't really matter too much because I put in 200,000, still 200,000 of equity right there. Okay.